Smart finance moves. Insight from CS and IP.
Welcome to IPO Insider. In today's episode, we're tackling one of the most crucial aspects of IPO investing, valuation and pricing. How does a company decide on its IPO price, and how can investors assess whether it's fair? If you've ever wondered whether an IPO is overpriced, underpriced, or worth the hype, this is the video for you. Let's break it all down. The price of an IPO is not arbitrary, it's the result of a careful balancing act between the company, underwriters, and market demand. During the IPO process, a company works with investment banks to determine an offer price that reflects the company's value while also attracting enough investor interest. One of the primary factors influencing IPO pricing is market demand. If there's significant interest from institutional and retail investors, the IPO might be priced on the higher end of its range. On the other hand, weak demand may result in a lower price to ensure the IPO is fully subscribed. For example, in a book-building IPO, a price range is set, and investors bid within that range. The final price is determined based on the highest demand, making it a dynamic process. One of the most widely used metrics to assess an IPO's valuation is the price-to-earnings (PE) ratio. The PE ratio compares the company's stock price to its earnings per share (EPS). A high PE ratio may indicate that the stock is overpriced, whereas a low PE ratio could signal undervaluation. Investors use the PE ratio to benchmark the IPO's valuation against its peers. For instance, if a tech company is going public, comparing its PE ratio to other listed tech companies can provide insight into whether it's fairly priced. However, it's important to note that a high PE ratio isn't always bad. It can indicate strong growth potential, especially for companies in emerging industries like AI or renewable energy. Assessing an IPO's valuation requires looking beyond just the pricing. Here are the key steps investors can take. Start by reviewing the company's financial statements, which are included in the IPO prospectus. Look for revenue growth. Is the company's revenue increasing year over year? Profitability. Is the company making a profit, or is it operating at a loss? Debt levels. High debt could signal financial risk. Use financial ratios, such as the PE ratio or price-to-sales (PES) ratio, to compare the IPO candidate with other companies in the same industry. If the IPO's ratios are significantly higher, it may be overvalued. Market conditions and investor sentiment play a big role in IPO performance. In bullish markets, IPOs tend to be priced higher and perform well. In contrast, bearish markets may lead to more cautious pricing. Understand how the company plans to use the funds raised. If the proceeds are earmarked for growth initiatives like expanding operations or investing in R&D, it's a positive sign. However, if the majority is used to pay off debt, it may raise concerns. The investment banks managing the IPO provide credibility. Reputable underwriters are more likely to back companies with strong fundamentals. Let's take a look at how valuation and pricing impacted the success of some well-known IPOs. Initially criticized for being overpriced, Facebook's IPO price of $38 seemed steep. However, the company's rapid growth and advertising dominance have since justified its valuation, with the stock soaring in subsequent years. Uber's IPO was highly anticipated but faced challenges due to concerns about its path to profitability. Priced at $45, the stock struggled initially, highlighting the importance of balancing growth potential with financial health. Paytm's IPO faced criticism for its high valuation and lack of clear profitability. Despite being a high-profile offering, its disappointing listing day highlighted the risks of overpricing. Valuation metrics like the PE ratio are invaluable tools for assessing IPO pricing. Excitement around an IPO doesn't always translate to long-term success. Focus on fundamentals. Evaluate the company's growth potential, market position, and use of proceeds to make an informed decision. Timing matters. IPOs launched during a bullish market often perform better. IPO valuation and pricing can seem complex, but by understanding the process and key metrics, investors can make smarter decisions. Whether it's assessing market demand, analyzing the P/E ratio, or learning from past IPOs, a little research goes a long way in navigating the IPO market. If you found this video helpful and want to continue enhancing your investment knowledge, make sure to subscribe to our channel and hit the notification bell so you don't miss any updates. Stay tuned for our next videos. Thank you for watching and happy investing.